Hello, ladies and gentlemen, and welcome to this installment of Livewire's 2021 income series, Solving the Income Puzzle. My name's James Marley. I'm a co-founder of Livewire Markets, and I'm joined on the line all the way from Chicago by Joe Lind, who's a senior portfolio manager at Neuberger Berman. Joe, thanks for taking the time to jump on the call, and great to meet you.
Yeah, nice to meet you as well. Thank you for having me.
Now, Joe, as I alluded to in our pre-call, a lot of Livewire investors are familiar with Neuberger Berman since the LIT MBI was brought to the Australian market, but I don't think many of us have had the chance to meet or hear from you. So perhaps as a starting point, you can tell us a little bit of your own background and maybe a few stories or anecdotes that have shaped the way that you think about investing.
So an American, lived in Boston for most of my life and moved to Chicago a few years ago to join Neuberger Berman. I've been involved in debt investing my entire career. I started investing in distressed debt and have worked was a portfolio manager for another investment manager for about 12 years, and then joined Neuberger Berman in the summer of 2018 as a senior portfolio manager. I'd known the team for many years, over 14 years prior to me joining Neuberger, and we had a very common philosophy and approach to investing. So it was a pretty easy transition, and I've really enjoyed the culture and process and size of the team that I get to work with at Neuberger. I think starting out in distressed and just seeing, in the late 90s and early 2000s, there were 4 straight years of record bankruptcies, and just seeing how things broke as a starting point was really helpful to just think of how things could break, even when we're investing in higher quality bonds that we don't anticipate a default. It's always nice to try and think through what might happen.
Tell us about the asset class, what defines it, what are we talking about?
Sure. Yeah, so we invest in non-investment grade debt across the world. And really that non-investment grade is a function of the credit rating. And so these are below investment grade, not quite. These are companies with either more debt, often are smaller than the large investment grade names that you've heard of, like Apple or ExxonMobil. And so these are, businesses that require more research and there's a higher risk of loss. But we feel that doing a lot of fundamental research, having a big team that's meeting with all the companies, that we can find investments that won't default and pay much higher interest rates than investment grade companies. So we can offer yields that right now are the spreads, the advantage over the risk-free rate is more than triple what the investment grade bonds offer. And so it's a big yield advantage. And we haven't had a default in the listed investment trust. And that's really the core focus, is making sure that we'll get paid back when we lend money.
Take me inside the room with your team of analysts and portfolio managers. What's the topic that the team is spending the most time debating right now, and why is it important?
Sure. We ask the team a lot of questions, and the one, and oftentimes we ask it over and over. And I think that the 2 big things we're really focused on now is just how persistent is inflation. We're hearing from companies that their costs are going up. I think if anyone's gone to restaurants or bought food or tried to buy, book services, that it's a lot more difficult now. Prices are higher, labor wages are going up, and we're trying to understand how much of that is just the difficulty of restarting, because it's a lot easier to shut something down than restart something back up, and how much of it is just a structural inflation. And then also, I think an important coupling to that is just how much of this is just really healthy demand. So our prices are higher because people there's massive amounts of demand and growth. And what I'd say right now is that we're seeing a lot more growth and demand than we're seeing inflation pressures and cost pressures. So what we hear from companies when we talk to them, and we did a whole survey over the summer where we contacted every company that we cover and interviewed them about, what inflation pressures they're seeing and what they're doing about it. And a common thing we heard back was that costs were up, and oftentimes costs could be up 8 or 10% over what they expected, but that they have so much demand that they can't yet meet all of the demand they see, and they expect to grow profits. And so that's something that in the high yield space, seeing the profits grow and seeing those balance sheets of the companies, having them generate cash and be able to pay down debt and have more cash to service debt is a lot more important than an effect of inflation. So those bonds are in essence getting safer as they're growing profits. And so far the scale's tipped towards demand, but that's something that, that's kind of in every meeting, our discussion probably touches upon that debate in one way or the other.
And so what are some of the conclusions that you come to, or the implications from an investment perspective that particularly in your space?
Mm-hmm. So we always want the portfolio to reflect what we think will happen on a macro basis, but really that's a sum of all the small decisions that we've made through the analyst team. And what that means for positioning. And if you looked at the portfolio, you'd see that we own more lower rated issuers. And there's really 3 broad categories of ratings in non-investment grade. There's double B, single B, and triple C. And that's sort of, higher quality, mid quality, and lower quality. And we're overweight single B and triple C because those businesses are the ones that will benefit the most from that growth. And we also think that the rating agencies that give those ratings are a little stale. And so we've seen a lot of upgrades. And just to give you an example, a couple of upgrades that have happened in the trust so far this year. One was in real estate brokerage. So, people want more house now after the pandemic, and we're seeing real estate transactions move a lot. And so that was downgraded because of the pandemic. And they're having, a wonderful year. They've paid off 10% of their debt. Realogy is the name of the investment. And that's been upgraded from triple C to single B. And we've also seen upgrades in the theme park space. Theme parks obviously should have gotten downgraded when COVID hit. But this summer, they generated cash. Their ticket prices are at all-time highs. Concessions are at all-time highs. And so even with 85% of the visitors, they're making just about as much money. And so we're seeing those get upgraded back to single B. And we've benefited from, as other investors recognize that this is good enough for those businesses, that the world doesn't need to get better. We all hope it does. Then, that's where those spread, the yield of those bonds decrease and the price goes up.
So there's effectively an arbitrage opportunity based on the ratings upgrade cycle that you're able to get ahead of.
Well, I wish it was as easy as arbitrage, but I'd say it's more that we have one of the largest research teams in the business. We have folks located all over the world looking at businesses and meeting with companies. And we think that we adjust our internal views on credit ratings a lot faster. And that's so our internal views are that a lot of the triple C names we own aren't triple Cs. And a lot of the single B names, can go to double B. And we also anticipate that there'll be a big wave of names that get upgraded even to investment grade. And so I think that it's that the hard work and flexibility and willingness to adjust is something that really helps. And we benefit when we're right. And I think that some of the credit rating agencies get a little concerned about perhaps having too high of a rating. If you remember in 2008, they came under a lot of criticism about being too slow to downgrade. And I think we're seeing kind of the opposite effect now, that they're being a little slow to upgrade.
When we started the conversation, you talked about, the names, the credit were named like the Apples and those sorts of companies that people would be familiar with. Could you give me a snapshot of some of the names that you hold in the trust that people might be familiar with, that give them a bit of a flavour, or even if they're not familiar with them, explain what the business is, maybe some characteristics around the number of positions you hold, the size of those companies from a market weight perspective, just give people a sense of what you're investing in?
Sure. Yeah, the overall, some of the larger names, we did have a lot of fallen angels come into our market, and so some of the names that are more familiar would be Ford Motor Credit, Rolls-Royce, and they're known for making aircraft engines, or at least they make a lot more aircraft engines than they do cars. Other names, that the cruise lines, so Carnival Cruise, Royal Caribbean, and those are all names that used to be investment grade, and then largely because of COVID, were downgraded into high yield and into non-investment grade, and we were able to essentially invest in businesses that are a lot bigger and often have a lot of different divisions that they can use to access capital. And that was something that gave us some opportunities to just to invest in very high quality businesses that we ultimately think people will drive cars. Those businesses have the wherewithal to handle even a few years of disruption before they really damage their balance sheet. Some other names that we do see. I think that a lot of them are often smaller, or that they're providing something that you touch a lot of. So food distribution companies that are delivering groceries to schools, supermarkets, restaurants. A lot of hospitals are in the high yield space, and the reason for that is just they normally have very predictable businesses, and so they can handle having some debt on their balance sheet. Strangely enough, most hospitals almost went bankrupt because of COVID. That business is really about getting your appendix out or fixing your knee, and not about global pandemic. So a lot of people stayed away from hospitals, and so really our job has been, which of these things are temporary and which of these things are permanent. And so maybe an example of some names that we've avoided that might come to mind are just the traditional broadcasting companies, so TV broadcasting, where we're seeing viewers move away from watching live TV where commercials pay the bills. We're also moving away from a lot of other traditional medias, and also businesses like retail, where we're seeing big changes in those sectors, and it's difficult for us to know what ultimately will happen. We're not sure how many malls, at least in the U.S., might need to close, but there's probably a few too many, and so that mall-based businesses are something that we're trying to avoid. So that type of how does e-commerce affect the world over the next 5 or 10 years? That's a pretty hard question, and one that would probably not make a big investment. That depends on us getting that right. But an example of the theme parks that we're pretty sure that 10 years, 20 years, 50 years from now, people will want to get some popcorn and ride a roller coaster. And so that trying to understand kind of long-term behavior is something that we spend our time doing.
And Joe, if we're just to step back from that micro portfolio level for a moment, and really just to call out for people that are looking at high yielding bonds and thinking about where this might fit in their portfolio and wanting to understand it more, what are some of the risks that you regularly call out for investors to understand in the asset class?
I think the biggest risk is always in non-investment grade. The question that everyone needs to ask is, will you get paid back? And so defaults are always the top of mind concern for investors, and really should be. And when we look at defaults right now, so far this year, it's well under 0.5%. And so, one way to think of it, if you think of it investing in a portfolio of high yield bonds, then you lend money at let's say 5%. And then if 1% of that portfolio goes bankrupt and you lose half that value, then you get 4.5% at the end of the year. And with the listed investment trust, the asset value and the NAV of the shares are above where we issued them when we first issued the shares, and so we haven't had net credit losses. And so that's really what we spend our time doing. Why we have analysts that have been industry experts now for decades, is to really just find out and avoid the situations where we're not going to get paid back 100 cents on the dollar. And when you look at this market right now, the capital markets, companies can borrow at pretty cheap levels relative to history, and the economies are growing. People talk that maybe the growth will slow, but that's still growth. And so we think that the default outlook for the next couple of years will be pretty low. In 2021 will likely stand as a record for low defaults in the market. And so that's a pretty good tailwind. If you have very few companies that do get into trouble, then that you're much more likely to get all the yield that you think you'll get.
I've really appreciated your time today. Thanks for providing such a clear explanation of the asset class and some of the opportunities you're seeing at the moment. And thanks for being involved in the income series this year.
Thank you very much for having me.